This is a Brooklyn News special report.
Good day to be with you. I'm Jackson Mitchell. We're coming on the air at this hour with breaking news. As you take a look there on your screen, Federal Reserve Chair Jerome Powell speaking from the Federal Reserve in Washington, D.C. This comes after the Fed has decided to lower interest rates by a quarter of a percent, by 0.25%. Let's listen in here for just a moment.
Projection in the SEP for total PCE inflation is 3.0% this year, and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
It's certainly possible. We're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, and this is quite an unusual situation, how do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very
Alrighty,
low.
you've been listening in there to Fed Chair Jerome Powell take questions from the press after a pretty big move. For the first time in 9 months, the Federal Reserve Board voting to lower interest rates just by 0.25%. Still, definitely a move there for the board to do. We want to break in and break down some things here that are want to talk about here. Let's start first with again this. You heard there when that ABC News reporter asking about if grocery prices are still rising, if what is the plan going forward? Because kind of a basic lesson here on economics. If uh, the interest rates are the Fed board votes to raise, I should say, those rates to combat inflation. And that is what has occurred. It has gone quite, the interest rates growing quite exponentially because of the COVID-19 pandemic. Now we are seeing for the first time again in 9 months, those rates being lowered. But inflation still set to rise there, is what you're hearing from Fed Chair Jerome Powell. He says, since we've essentially saying, since we've already experienced this before, we're going to watch it kind of as it plays out there. We also have this story released this morning from the Washington Journal saying what to watch at the strangest Fed meeting in years, highlighting kind of this uncertainty in the Federal Reserve. We have the drama with Lisa Cook. President Donald Trump trying to oust her. Courts ruling pretty much at the same time that a vacant seat was filled, and the Senate confirming that seat, that Trump cannot oust Cook. Stephen Moran set to fill that place, that vacant seat, not Lisa Cook's, but rather another vacant seat on the board. But again, the big news here for the first time here in 9 months, the Federal Reserve, kind of the board there voting to lower interest rates. Let's go ahead. Just wanted to interrupt here. If you're just joining us, I know we have a lot kind of going on here as we've been listening in for the last little bit as the press has asked questions as he takes press after the board voted to lower interest rates again by just 0.25%. Still some move here. I'll read a paragraph from this story. Again, we were just talking about it. What to watch at the strangest Fed meeting in years. That's from the Washington Journal. It reads, quote, no, wrong paragraph there. Sorry. That raises the question of how fast officials think they should nudge rates to neutral, a moving target that frustratingly imprecise. The benchmark Fed funds rate is around 4.3%, while Fed officials think the neutral rate is around 3%. They have been revising up their estimates in the last few years. Kaplan's caution about cutting rates reflects his view that neutral is cut currently higher at around 3.5%, which would mean the Fed only needs to make 3 of 4 quarter-point cuts before getting there. So that news coming in. Again, just a little paragraph there from that story by the Washington Journal. To kind of bring it into focus, things have slowed when it comes to the buying market, the housing market, which also affects interest rates. Of course, people who own homes and have owned homes before interest rates have skyrocketed like they have are holding on to that because they feel that they, if they were to sell, if they're at a 2% interest rate, that could raise to 4 by the time they find a new home. So that's something to note. That is also in affecting a feature that is going to affect what the Federal Reserve Board does, but also where numbers say when we talk about the labor market, the jobs market, where things stand there. That is one of those things that will affect it. Fed Chair Jerome Powell also saying that the need for jobs has also gone down just a little bit while the more jobs being created. 22,000 was where we were at last month. We'll see what this month has as the month just started. It's only September 17th. Maybe it hasn't just started. It's been going for a little bit there. So that is the news that we're following. We are going to continue to monitor this press conference ongoing. Why don't we listen in for just a little bit longer here as you see there Fed Chair Jerome Powell continuing to take questions.
So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having really a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened.
Okay, no, we just dipped in there for another few moments. We will continue listening again. Fed Chair Jerome Powell taking questions from the press after lowering interest rates by 0.25%. We will continue monitoring that. We want to, before we wrap up our special report here, as we're on the air for just a few moments, we want to talk about some more stories that we're following. Let's take you out first to a story that is happening over in the Senate. Moments ago, maybe appears to have wrapped up, but Kash Patel, the FBI director, was facing questions, pretty intense questions, on the Charlie Kirk assassination. Maybe they're in a break, or again, someone else is being questioned there. We are going to keep with this story. This is the second day that he has been on Capitol Hill facing questions. The first, where it became pretty fiery between him and Democrats as they questioned him harsh on things he has done since being put in, being confirmed by the Senate as director of the FBI. We're also following another story this hour. President Donald Trump is in the United Kingdom. This is the second state visit. Let's take you over there. If you'll hold with me for just a second, getting that feed ready for you guys. Here we go. Let's take you over to the United Kingdom, where President Donald Trump is visiting for his second state visit. It's a rare moment because it is not usual for a president in their second term to visit the country again. This visit to kind of emphasize and better the relationship between the United States and the United Kingdom. I believe there's another event that is going to happen a little later for you guys on this. You'll stand by with me. I think there is another event that is expected to get underway here. This is a live look at the Windsor, where these events are all kind of getting underway. Okay. Okay, let me see here what the schedule is looking like. Sorry, I have a schedule that I'm able to look at that has it's more on paper, so I'm able to see kind of the central time compared to the Britain time that they are on BST, which is UK time. He has an event coming up at 2:30, so about 30 minutes from now here in Central Time, the state banquet. I wonder if that is going to be public to the press. I'm not sure. We'll kind of watch that goes. Tomorrow, it's going to be a very busy morning. Well, I know he does depart London for the US at 11:05 a.m., but the morning starts at 4 a.m., where he gives a farewell to the King and Queen, King Charles and Queen Camilla. He departs Windsor for Chunker's bilateral meeting with Prime Minister Keir Starmer, business leaders reception, press conference with Prime Minister Starmer. I'm sure we will. That press conference is at 8:20 a.m., 6:45 a.m. for the business leaders reception. Depends on where things go tonight, if I'm going to be on the air for some of that. I know that how early that is in the morning, but I'm sure I'll be up monitoring it and hearing about it throughout the day on the news. So reading some stories about it, I'm sure, as well. Again, the story you're following there, President Donald Trump visiting the UK for the second time. Before we leave you, why don't we take a look over at the Dow Jones, who we have a live look on. Stand with me here. See if I can change something really quickly. Okay, let's take a look at the Dow Jones that we've been looking. This is via a YouTube feed that we are in from Fortex Education Live. There's a look at the Dow Jones. You can see kind of the moment that it all occurred. Lots of selling happening while the Dow Jones is up 103.104. You're seeing it there, up over 100 points today, kind of going down. I believe maybe as we saw that come through, but maybe it's going back up. Not sure there. We'll keep watching the Dow Jones. Stock's kind of confusing. I try my best to understand the best that I can. But and be able to explain that to you guys. We are waiting for a dinner to happen over in the UK. If that is something that we are able to air, trust, we will be on the air right back for it. So, for all of us here at Brooklyn News, that does it for us. Have a great rest of your day, everyone, and evening as 2 p.m. now here on the Central Time Zone. Have a great day, everybody.